Welcome back, guys. For those of you that are new here, this is a series of videos that documents a journey to grow a $500 Robinhood account. And if you want to see part one, I'll link it up here in the corner. And if you want to stick around and follow this journey and see it through, we're going to be talking about day trading, fundamentals, swing trading, options, all that kind of stuff. So if you want to see more of this, you can click the subscribe button and the bell next to it. They mean a lot to me, and you'll get notified of future videos just like this one. And this is part two of this series. And speaking of, this is my second take, because my first take, I literally blabbered on for about 30 minutes, watched part of it, and went, I got to put this into something more manageable. So that's what I'm going to try to do here. If I rush through anything, ask me a question in the comments, and I'll definitely respond. I respond to everybody. So I will answer your questions if you have any. So let's take a look at my account balance. Week before last, awesome. Things were looking great. Last week, not so hot. I'm sitting at 505.26, which is up from the 491 I was at a few weeks ago, so that's good. But Facebook has been pulling me down pretty hard based on news. They've had some executives leaving and have a lawsuit filed against them. I do not plan on selling Facebook. I think they're a massive company with big market share, and they don't look like they're going away anytime soon, and they have a lot of money to work with and branch out to new opportunities, plus a great product portfolio. So if they start losing money and becoming not profitable, which I don't foresee in the near future, then I might reconsider my position in Facebook. But right now it's only one share anyway, so I'm not too concerned. So Facebook's been dragging me down all of last week. I've been combating against it, doing a couple day trades that I will discuss here shortly. But let's go through my other positions. I'm still holding Waste Management, and I plan to hold that indefinitely. What may happen, though, because they are trading a little bit high, is that that price could have a correction, meaning that it will go down. Because as things go up for an extended period of time, they tend to have these kind of corrections. When it does go down, I plan on buying again. I do this with long-term investments, and it's called averaging down. What ends up happening is the average share price paid, and you can see this in Robinhood. I'll probably put a screenshot somewhere. The average share price paid will be reduced, because if I bought one share for $100 and then it went down, and I bought another share for $90 and I bought one there, then my average price paid is going to be $95. What this does is instead of it having to go all the way back up to 100 and above to make money, it only has to go to 95. So for long-term investments, that's awesome. Don't do it for day trading or swing trading. Only average up for swing trades. If you're averaging down, what you're doing is buying into something that you were wrong about. And you don't want to keep doing that because you'll keep averaging down, losing a lot of money. It's just a messy way to trade. Don't average down on swing trades or day trades is my personal opinion. Now let's talk about the day trades I did do. One I did under the triple leveraged inverse of the S&P 500. That is SPXS. So every time the S&P 500 goes down $1, this one attempts to make 3. So I'm going to be looking at SPY, which is the ETF of the S&P 500. So you're basically looking at the S&P 500 just because it's easier to think of it in the terms of I'm shorting this market. So that's what we're going to be looking at. If that doesn't make sense, that's all right. You'll see what I'm talking about here in a second. So you can see that little red arrow, not that one down below. That red one there, that's when I entered the trade. When you're day trading, everything revolves around support and resistance. Support is price levels where the price action, the movement of the price, tends to bounce off of on the bottom. Resistance is where price action tends to bounce off of it on the top. Now, the price can bust through those levels, and that's called a breakout, and that can totally happen. The stock price can do whatever it wants. People are buying and selling. Financial institutions are buying and selling. It will do whatever it wants, but it has a tendency to be supported or resisted in certain price levels. In this day trade, I used this concept and applied it to moving averages in the VWAP. I will link some information on moving averages down below in the description, just so you can learn more exactly what they are. But think of them as lines that provide support and resistance levels. When price action is below these lines, they're going to be resisted by them. When it's above these lines, they're going to be supported by them. They can always break through. That's totally a possibility. But I will show you how I use this in my day trade to make some money. In case y'all are curious really quick, this is Thinkorswim by TD Ameritrade. Free to set up. And it has pretty much everything you need. Everything you'd ever need for charting. It's fantastic. A lot of stuff that most people require you to pay for. It's all here for free. You don't have to fund your account or anything. However, pro tip, if you do download this, in the top left, it's going to say delayed data. And I'm going to put something in the description that will show you how to get real-time data, meaning that the prices are updated in real time as compared to being delayed 20 minutes. So definitely check that out. A lot of people miss that, and You can't day trade 20 minutes behind. That's horrible. Would not be good. So as you can see here, this red arrow, it's a little bit off. I entered on this red candle here. What I was looking for is that it was trading below the white line, which is the volume weighted average price, or the VWAP. That provides resistance, and when price is trading below that line, it tends to be in a downtrend. So I never buy when I'm day trading and it is trading underneath the VWAP. I only sell short or buy inverse in ETFs. Or buy puts or whatever. So you can see it started off the day going down, busted through the 9 EMA, the blue line, and the VWAP. The green line is the 180 SMA, simple moving average, EMA being exponential moving average. I was looking for a confirmation that it was going to continue its downtrend and not bust back up and have a big bounce or anything like that. So that confirmation was right here, right in this red candle. When it went up and was rejected both by the VWAP and the EMA, which were resistance for this price action. When it got rejected, I decided that's a downtrend. We're ready to go. So I went ahead and bought a good handful of shares of that inverse ETF, and I kept buying into it as it went down, as it kept bouncing off of that EMA. I kept buying into it, and I closed out as soon as it crossed above that EMA there. I decided I don't want to stay in it any longer. And I made good money off of that. I'm breezing right through this stuff, guys. Keep up. So my next day trade was on Facebook, and this one was not the smartest one. It was more of a, I'm gonna be honest, I was trading a little bit, I was a sour boy. I was getting my portfolio yanked down. I was like, gosh darn it, I'm gonna make money off of Facebook. So I decided I'm gonna day trade Facebook. When I was looking at it, I saw a good opportunity. Day trade Facebook with options. It's a decent opportunity. It wasn't really good. I wouldn't really do it again. But you can see here how it's trading above the VWAP. We're not gonna talk about these dotted lines right now, but it's trading above the VWAP. When it's trading above the VWAP, it tends to be an uptrend. So I was looking for a confirmation of the uptrend. Right here, when I saw it bounced off the 9 EMA, it acted as support. When I saw that it bounced off and that fat green candle appeared, I decided that was enough of a confirmation that it was going to continue in its uptrend. Not to mention that this low right here is higher than this low back here. And that's what you're looking for in an uptrend, is higher highs and higher lows, okay? So just that kind of stereotypical uptrend pattern of stocks. And you can see how powerful this was. I bought an out-of-the-money call that expired the next week for 25 bucks, sold it, what was that, 30 minutes later or so for a $6 profit, which isn't huge, but it's $6 for a $500 account. So it was significant and counteracted a good chunk of my Facebook losses from all that bad news that came out. Whew, okay, so that's done with. If you have any questions about that, let me know. Don't buy out of the money options that are like $1, because sometimes, I mean, you can if you want, but it can take a while for that price to move just because of how the Greeks work in that. Buy out of the money options that have some value to them, that aren't just like a complete dirt cheap, like way out there, like $1 Facebook options. You can do that by trading options on cheap ETFs, because the options under cheap ETFs are going to be cheap. Some cheap ETFs are like USO or SLV or UNG. The share price is really cheap. You can buy really at the money or barely out of the money options for not that much. The problem with buying slightly out of the money options on big stocks like Facebook is that, like, I took some risk. I bought a $25 call, and if the stock price started turning against me really quick, the thing with Facebook is you don't have stop losses for options, and it can, if you put a limit order and it sends right after the stock price starts busting down and it doesn't get filled, you have to cancel it, replace it, send another one, and it can keep busting down, and you can lose all of the value of that call option pretty quick. So it's good to trade cheap options so that if things turn against you really fast in Robinhood, it's not that big of a deal. Maybe you bought a $5 option and it went against you and you couldn't exit out at all and you lost all $5 or whatever. That's not that big of a deal. So trading cheap options is awesome, and you can trade them under cheap ETFs. This is fast. Believe it or not, this is faster than my last take, and this is taking forever. I got one more thing to talk to you guys about. I bought a few shares of ATVI. We're going to ignore the fact that I got some HPE. I don't want to talk about it right now. I'm getting too long anyway. But I bought some shares of Activision. And in the description, I'm going to link you to a service that Ali Bank provides that you can look up a ticker and it'll provide you a snapshot of the stock's fundamentals. And today I want to talk to you about the PE ratio. This is one aspect of Activision, one aspect of several that made me think that it was a good buy. What the PE ratio is, and you've probably heard of it, it's also known as a price multiple. It's calculated by taking the share price and dividing it by the aggregate last 12 months earnings per share. So you take price, share price divided by earnings per share for the last 12 months. And that's how you get your PE ratio. So how can you use this in trading? And like, what does it mean? Well, what it's saying is, and you can see here the 17.89, it's saying that when people buy a share of Activision, they are paying $17.89 for every $1 of earnings the company has. So the PE ratio, when it is low, and I'll explain, it'll all come together here in a second. When the PE ratio is low, it has a tendency to expand, low to its industry or low to its previous PE ratios. It tends to expand. When it is high, when the PE ratio is big, it has a tendency to contract. A lot of trading has to do with reversion to the mean, and this is a good example. When it expands and contracts, one of two things can happen. So in this case, 17.89 is pretty low for the industry. You can see that right there. It's pretty low for the industry. I expect that it could expand. The PE ratio can expand in one of two ways. Either price, share price increases, or earnings decreases. So what I'm looking at here is I'm guessing that the stock price is undervalued because the PE ratio is low. And I do not expect earnings to go down. I expect price to increase. If price increases and earnings remain the same, if share price increases and earnings remain the same, that's going to cause the ratio to get bigger and expand. That's what I think is going to happen because I think they have a pretty solid business model. Another way that PE ratio could expand from 17.9 upwards is earnings could decrease. Because if the denominator decreases, then the overall value of the fraction is going to, or the ratio is going to increase. You can see now it's either share price increasing or earnings decreasing. So it could be a good thing or a bad thing. But I think their business model is solid, and looking at other stuff that I'm not going to go into right now, I think that the share price is going to increase and the earnings is not going to decrease. Okay, I really zipped through that one. So definitely, I'm going to put some information down in the description about PE ratio. Investopedia has a great article on it, or if you want to call it article. So I'll put that down below for you to read, and hopefully it'll piece it all together for you if you don't understand it quite yet. I'm done. That's it. I can't talk. If I talk anymore, I'll just keep going. Please, if you have any questions, let me know. I respond to literally everybody as long as I get the notification. Sometimes it sneaks through that I don't, but just comment again if I don't respond to you within a day. But I try to respond to everybody. Thanks for watching, guys. I love you. Have a great week.